there's no question that the lack of inflation is a plus for owners. I mean, the real return you will obtain, in my view, from owning American business, if purchased at similar prices, the real return will be higher if we have long periods of low or close to no inflation than if we had long periods of high inflation. I don't think there's any question about that, because that article went on to explain how you got taxed on nominal returns and fictitious returns in real terms. So your question is about which period is better for investors. A low inflation period over any long period is better for investors. And the problem, as you pointed out also, was the starting point in terms of predicting modest returns for equity investors. The returns weren't necessarily so modest, I predicted. They were just modest compared to what people had begun to think returns would be during that long bull market from 1982 to 1999. There were polls taken by Gallup, working with, I think, Payne Weber at the time. Now they've moved it over to UBS Warburg, that showed the expectancy of people in the stock market, and those returns that people expected got up to 14 or 15%, as I remember. And they were thinking they were going to get 14 or 15% in a low inflation environment. Well, that was dreaming. And there's nothing wrong in a low inflation environment at all in earning 6 or 7%. That's probably as well. Well, it is as good as will happen, because in a low inflation environment, how much is GDP going to grow? Well, GDP, if you have a 2% inflation and even 3% real growth, you're talking about 5% in nominal terms GDP growing. If GDP grows at that rate, over time corporate profits will grow more or less at that rate. And if corporate profits grow at 5% a year, the value of those corporate profits, the capitalized value, will probably grow at something like that over any long term with a sort of a normal starting point. And add that to dividends, and you will get 6 or 7% before frictional costs. Investors incur a lot of frictional costs. They don't have to, but they do, and that often is 1.5%, 2% of their investment. So the math isn't bad. It's just bad for those people that got used to or expected very high returns based on looking in the rearview mirror back in 1998 or 1999. In effect, if the people who own American business get 5 to 6% of the pie, $10 trillion economy now, someday a $20 trillion economy. But if we get 5 or 6% of the pie, those of us who put our capital out to produce goods and services for American business, for American consumers, American population, is that I don't know whether that's, is exactly what somebody who designed the universe would come up with, but it doesn't strike me as crazy in either direction. I think that that's a lot of goods and services to go to people that put up the capital, and you've got 100 million plus people in the working force that are working to turn that out for you using your capital, and it provides what I would regard as a pretty decent real return if you have low inflation. If you get into high inflation, as I wrote about back in '77, you could easily have the real return to investors get to a very, very low number, and perhaps negative. I mean, inflation can swindle the equity investor, as I wrote back then, and I used 7,000 words to explain why. I will be glad to send you a copy of that article if anyone's still interested. But inflation is the one thing that over a long period of time can turn investors' results in aggregate into a negative figure. And it's the investor's enemy. The best business to have during inflation is one that retains its earning power in real dollars without commensurate investment to, in effect, fund the inflation produced nominal growth. The worst kind of business is where you have to keep putting more and more money in to a lousy business. In effect, the airlines have been hurt by inflation over the last 40 years because now they have to put a whole lot of money in a lousy investment, which is a plane, compared to 30 or 40 years ago, and they have to stay in the game. They have to keep buying new planes and the new planes cost far more now, and the returns continue to be inadequate. So the best protection is a very good business that does not require big capital investment. So inflation is always a factor in calculating the kind of investment, kind of business that we want to buy, but it isn't like it crowds out all other factors. I mean, it's always been with us. We'll think about it always. See's Candy has done fine during an inflationary period because it does not have huge capital investments that have to be made in current dollars. Other businesses we have, the public utility business, for example, it costs a lot more money to maintain capital expenditures now in dollar terms than it would have 30 years ago. So you have to keep putting more and more money into a public utility, and you better hope that the rate of return allowed is commensurate in times of high inflation, the same way that it might have been in low inflation with a lower rate of return. The best investment against inflation is to improve your own earning power, your own talents. Very few people maximize their talents. And if you increase your talents, they can't tax it while you're doing it. They can't take it away from you. So if you become more useful in your activities, your profession, doctor, lawyer, whatever it may be, that is the best protection against a currency that might decline at a rapid rate.